Welcome back to Vantage. When you hear that Larry Fink is thinking about deploying more capital into the UK, it's worth taking another look. We've got another manager who's a veteran investor in the UK market. Let's go take a look. Welcome back to Vantage. We are continuing the theme of taking a look at the UK small cap sector. Have another veteran investor. Welcome to Vantage, Richard. Welcome again. You have been on the cameras, but there's been a few changes, so it's worth just reintroducing yourself and the funds you manage. I also wanted to draw on the fact that you've got a great long-term track record. When I looked it up, it's like 500% return since 2005, which is significant a level of outperformance. Be interested, as well as sort of talking about yourself, the fund, the investment process, and the philosophy that sort of contributed to that.
Yes, there's quite a bit there, but thank you for inviting me. Very nice to be here. Oberon, we're relaunching the three funds. They are UK concentrated stock picking funds.
Yeah.
Quite different to sort of institutional style funds where people are very close to index. I've always done stock picking. I started off with privatization issues back in the mid 80s. Used pocket money and gardening money to invest in those. Joined the profession in the early 90s. And then in the last 20 years, you talked about my career that we've outperformed by 4% per annum.
Yeah.
The main thing that we've done is we've bought growth companies in downturns. So we're a contrarian buyer of growth companies. So when the economy is a little bit difficult and there's really some quite difficult prints for some of these businesses, we sort of can see and we go looking for those companies that got long-term growth prospects. And quite often people are selling them down at sort of lowly prices. So we have outperformed by 4% per annum over 20 years. That's, it's 200 or 300% more than the UK market, but 130% of that has come from 4 years where you had the upswings in 2008, 2009, and 2020. And I joined the M&G recovery team back in, I think it was 1996 or something like that, a long time ago.
Yeah.
And so I like that contrarian approach.
Yeah.
But I also ran a tech fund in 2000. So like all of us, you don't always realize it. It's a sort of marriage of things that I've done in the past. So it's recovery investing meets interesting growth stocks, quite often on major themes or trends. And at the minute, you can get them very, very cheaply. And there might even be a danger of some of them going up soon as well.
Yeah, it seems that the market's sort of turning and interest in the UK is coming back. The three funds, UK Core, UK Special Sits, and UK Smaller Companies. Talk to us about the differences and also the similarities, what knits them together as well.
Yeah, so the central one that is most like that track record of outperformance is the Special Sits Fund. Effectively, at the minute, it's a recovery fund in these kind of growth companies across large, mid, and small. It's typically a third in some large, stable businesses. 6 or 7 out of the top 100, and then it's roughly 30 or 40 in the other two. The aggressive version of that is the smaller microcap fund, where we have pretty much 100% of it in small and microcap companies in these sort of contrarian growth style. That sounds really attractive. That potentially that could have much stronger returns even than we've delivered, but you have to have a longer term approach. And if you're selling a house, you certainly wouldn't. Not that we're going to give any advice. You certainly wouldn't be going for that. The core fund is like the Special Sits Fund, but less aggressive, and it has a 4% plus yield on it potentially. So some people do like income, so it's an income and growth type style.
You look at sort of unloved areas in the market. It's been hard work in small caps. It's been really hard work, and I think the data has showed that UK small caps have experienced their third worst run effectively the century since September 20. And that started in September 2021. It's been significantly worse than the sort of large cap. And, when you look at the sort of dot-com bubble bursting of GFC, it's been worse than that. What do you think has sort of contributed to this sort of historic underperformance? And why do you think this presents an opportunity now? Why it might change?
Okay, so since September 21, as you say, the underperformance, so your FTSE's up about 20%, which is not too bad.
Yeah.
Probably worse than the US. The A market is down 50%, and that's an average.
Yeah.
So that's twice as bad as in the GFC. Now, I recall in the GFC trying to find banks because we thought they were going bust across the weekend, and people queuing down the street for Northern Rock, because they were worried about their savings. There have been headwinds with rates going up. Luckily, they're going down now, but there have been headwinds. It has damaged trading performances, but the economic backdrop is nowhere near as bad as those, and yet it's twice as bad. The reason why it's an opportunity is that since 1955, small companies have outperformed, but they've been very cyclical. I mean, our performance tends to mirror that cycle. When the down dips come, small companies underperform, but when they recover, they make up. And over the long period of time, small companies outperform by 2.5%.
Yeah.
The bottom 2% of the market, more than that 4%. And actually, it's not about buying small caps or AIM. It's about finding companies that are down a lot, that are just mispriced.
It's particularly, well, yeah, I completely get that, but I think AIM's suffered quite a lot of that, so I suspect quite a lot of the opportunities there. Again, I think you sent me a presentation that sort of highlighted that 30% of AIM stocks were down more than 80%, and 45% of AIM companies now have market caps sort of below 20 million, so probably no one looks at them. Is that dislocation in the market where you see the opportunity, and then how are you sort of capitalizing on that?
So it is an opportunity because we're not looking to buy everything.
Yeah.
I mean, the AIM market over 20, 25 years hasn't particularly performed, but we and many of the other small cap managers have. And it's by finding the proper businesses. Maybe they've been a little bit dented. Maybe they're long-term growth businesses where actually there's no growth and the profits are down in the last couple of years. Mm-hmm. But actually, intrinsically, they're going to grow very well. Those have been multibaggers for a lot of people, and indeed for us.
Yeah.
And we go, because we have that contrarian approach and we like growth businesses, it is that marriage of growth and value. You make a lot of money in stocks by either buying companies that compound. Now everybody knows about those and they're expensive, or you buy things that are fundamentally the wrong price. Because the down dip has been particularly pronounced 3.5 years now, you've got a marriage of both, so that at some point the economy might actually help some of these companies. And then you have companies that are actually a little bit below the radar for a lot of institutions. And they'll see improving profits, possibly an uplift in valuations. And then you have increased adoption. So you get a triple whammy, and then you get often multiple increases.
Yeah. Well, I really enjoyed our sort of dialogue recently when I wrote up the inside the mind of the investor, and particularly around this idea of the 100 baggers.
Yeah.
We've been studying that. Would love to understand, what you think the sort of common characteristics of those multi-baggers are, and if you could sort of, lots of factors, but which ones do you particularly focus on?
Yeah, I mean, the reason why we did this was to sort of educate the process.
Yeah.
Typically, we have a hit rate a bit over 50%, 50, 55%. Mm-hmm. Might not sound a lot, but we make a lot more from the winners than the losers.
Yeah.
And it also skews very much to when you get the periods of recovery. And so we've had a lot of big gainers over my career on hundreds and hundreds of millions of pounds and hundreds of investments. So it's actually a small sector, but we have had stocks that have gone up 5, 10 times, 20 or 30 of them.
Yeah.
One stock once went up 200-fold. We're trying to educate the process so that our hit rate is better. We get slightly more. It's slightly easier to find the winners, and then we hang on to the ones as well once we got them. In terms of, a simple way of thinking about it, we have a word, grasp, which is my northern accent there.
Yeah.
Short A, G-R-A-S-P, obviously. G is for growth.
Yeah.
R is for return on capital. A would be the alignment. So it's very important that the management teams are aligned with the shareholders.
Yeah.
And S would be for small, and P would be for price. So, the fact that a lot of companies now have gone way smaller and have very low valuations means it should be a pretty good hunting ground.
Yeah. And within your portfolio, there's one company in particular that's done well, which again, for a lot of people is off radar, Zegona Communications. What drew your attention to it? It's I think it's one of the largest holdings across all your funds.
Yeah.
And where do you see it going? I mean, it's been an extraordinary sort of story so far.
Yeah. Well, we first came across Zegona. I owned 10% of that company and a previous guy's. It was called Zegona then, but it was Spanish telecom assets, cable assets as it happened. They did a buy, aggregate, improve, and sell, and that was lucrative for investors. And they came back and they bought Vodafone Spain. So the attraction of that, a bit like maybe some of the old privatization issues, a very well invested asset, Vodafone Spain, not perhaps optimized. And the management team were very convincing as to how they could change multiple metrics and vastly improve the returns. They paid a low price for it. If they improved it, then they would get, very leveraged into it. It's quoted leverage buyout structure.
Yeah.
So it's a special sit. Well,
yeah,
that's what we do.
Yeah.
But it's not mainstream in that sense. It was an introduction. It was raise capital to do it. For those people that very much needed the 3-year track record and everything, as many processes do, they wouldn't have looked at it. It's gone from £1.50 to £6.40. Its prospects from here, they will continue to improve the operating metrics. I'm convinced of that. They would like to sell the network. There are many of these very big infrastructure companies that will pay 14, 15 times EBITDA for that kind of thing.
Yeah.
Contrast to them paying 5 times. So they will pay away some of their line rentals every month to an infrastructure company, a very big pension fund or Singaporean, Canadian or whatever, and then potentially get in a large amount of capital for that. So that's slightly binary at the minute. It's a slightly less obvious economic backdrop around Trump and rates and stuff. But if they do that, then the shares could double from here. But we've taken some profits because they've gone from 150 to £6.40.
Yeah.
But basically, it's a management team we liked, special sit. You could see upside. They were very aligned to improving the assets.
Okay. And there are other things in the portfolio that we looked at. Maybe talk through, a couple of things that you think actually these things are mispriced.
Yeah.
There's valuation upside and the rationale.
Yeah, there's all sorts of asymmetric risk. And asymmetric risk comes in different forms. You can have businesses where you have limited downside and you can double or maybe treble your money over 4 or 5 years.
Yeah.
Not the 100 baggers or anything like that. You can't usually see them at this stage. So something like animal care we like. The management, the chairman is ex Decra, which went from, I think, 20 to 38 quid. So 30 bagger over a long period of time. They're in veterinary drugs. It's taken a little while to get that to the stage where it's at now, but the chief exec is not Decra, but she's ex-AstraZeneca. It's very well managed. They've just done some acquisitions. They have firepower to increase the EBITDA. It's a very attractive market. The multiple is about 9 times EBITDA. The right price is probably 50% higher than that, which should grow every year.
Yeah.
And then they've got some really interesting projects which may or may not happen, which give you a kind of venture capital upside. They've got some drugs that potentially would add £50 million to the profits, which would be a huge kicker onto the share price. They may or may not happen, but that's not in the price. So there's good upside to that. Elsewhere, that you have sort of breakup recovery type plays where you do the sum of the parts, not necessarily going to be broken up, but BATM, it's based in Tel Aviv and there's obviously been a narrative around the Middle East. But at one point that business was in the FTSE. We're not saying that's going to happen again, but if you add up the various bits, you've got cash, you've got some non-core assets, you've got a traditional telecom business. We think those are worth the market cap. And then you've got 3 or 4 things that are interesting over and above that. You've got a cyber business, and Israel is very, very renowned for creating cyber businesses out of the defense industry there.
Yeah.
And it does threat protection for the nation of Israel. They're moving out to enterprise. As profits are growing nicely there, quite a lot around quantum key encryption, which people could really be quite excited about if they dared to look at it. That's interesting. They've got another business called Agility. They've got a molecular diagnostic business called Adore, which ADOR. People could look at it on the internet. That's slightly more binary, but potentially it's a platform technology. It's really quite clever what they do. That could be worth quite a lot of money. Again, we think you get that for free. And then they've got a traditional diagnostic business that was bought from Merck Serono. So it was once a proper asset. They bought it. But I think they've got a freehold office building in Rome that's possibly worth quite a lot of money as well. So, people aren't looking at it. It's not particularly in favour. But when sentiment swings, people sort of start looking and going, oh, Softbiz, that was cheap. Why did we buy that when it was
Yeah.
15p or 13p? Yeah, so there's all sorts of there's far more ideas than we've got money to invest in a minute, but that's what happens at the bottom of the market. How long it takes for them to come good? Some of them, it feels like some of them are starting to move a little bit.
Yeah.
Some of them will take longer, but the upside for investing in small and micro cap at the minute is it should be really quite good.
That's been really good. And I guess the final thing within that is, so I think compelling reasons to take a look from a valuation perspective, things overlooked. That you painted this picture where over time you will get those realizations and variation. I think it's one around sort of timing. What's the mood music like now in terms of small cap? You've seen, we made this call in December that we would start to see diversification out the US and fund flows coming into other markets, and largely been borne out through the first quarter. There's always wobbles around that. How are you feeling that the environment's a little bit better?
Yeah, I mean, nobody's going to call a recovery from here, but if there were to be a recovery, it might look like it's looked since the end of March. The attitude is a bit better. Maybe people are diverse. Well, they put too much money in the US.
Yeah.
And they discover that when there's a 10% correction. But there are allegedly people from the US coming over here to look at UK assets. We think people are talking about it. Yeah. But also the portfolio managers are looking at specific companies. People trying to buy baskets of UK cyclicals. We are seeing some activities in some of the micro caps that have just felt like the wrong price, but everybody's going, when are these going to go up? They're totally the wrong price. Many companies are that way, but you're starting to see a little bit of a movement.
Yeah.
It could still go a lot further. And usually what happens is if there's any activity, it goes into the mid cap and then the large small caps and it trickles down. So you could argue, well, why not buy the large cap cyclicals? But given that sell down that we've had, then the micro cap has been so much worse than the FTSE. When they go, they will go a lot further. But you'll get some wrong and you get some right. But often big performance. People's careers are made by buying some of the stocks at the bottom that are below the radar.
Yeah. Fascinating. Richard, thank you so much for coming back onto the cameras. Yeah. We look forward to seeing how the year develops and wish you luck.
Fingers crossed. Thank you very much.